Good morning. This is Vince Lanci. This is the Gold Fix. Previously started at 7:30 in the morning. Too early for my blood. I asked and was given permission to start at 8 a.m. If you have been logged on since 7:30, I apologize. Stay with us, and you'll get a concise report on the events of yesterday, as well as turn off notifications. Facebook is going to be deleted from my phone soon anyway. Okay. Quickly through, I think, what are the top 5 things to look through today, and then we'll talk about yesterday's activity, which is very relevant going forward and set us up possibly for a what I would call a bull trap, although you can't be sure. Okay, so you have a hurricane that's touching on Florida. That's going to affect your energies. Natural gas has been reacting particularly violently attributed to that. But Bryn Kelly, one of our team members here, believes it's moving for different reasons. The hurricane just an excuse for it to go up. Donald Trump yesterday basically said that he's not happy with Powell, says the Fed is moving too fast, on raising interest rates. And then there's also hopes of a Brexit deal rise. The focus today, I think, is going to be on what Trump did yesterday, what Trump said yesterday, how the market reacted, and what it could mean moving forward, as well as today's PMI number. PPI, not PMI. PPI will, I believe, and have contended on the roadmap with Larry that my first thesis was the stock market for the last 2 months had been rallying while Europe and emerging markets were struggling, almost as if the market was daring the Fed, Powell, to continue raising in light of potential contagion coming to the U.S. Powell does not seem to have any fear of contagion, and thus far, he's been proven correct. And the flip side of that coin of I dare you to raise rates, I'm rallying into it. I don't think you will. Powell can easily say, well, the higher the market goes, the more I can raise rates, because falling 2% from all-time highs is not as bad as falling 2% from 100 handles lower. So I think Powell wins in that game of chicken. What I think is different about him, or interesting if you're watching his behavior, is that Powell has been a hawk. Now, he made one very dovish statement during Jackson Hole, but since then he's gone back to his hawkish commentary. And what has started to happen, as opposed to with Yellen, where you would get a number would be bearish for the economy, next number would be bullish, and you get a lot of mixed signals. We're getting, I think, the last 3 numbers are very consistently showing progress in the market. Now, the jobs numbers are a different story that we just had. But for example, the MO, I think, for Powell is he'll come out and say something when there's no number out, and he'll basically say, the economy's robust. We believe things are going well, and we believe we're near full. All positive things. And there are some things that he says that make you concerned, that they don't know what they're talking about in terms of what a neutral rate is. But we can talk about that as well. But the MO goes like this: Powell raises rates, right? This is the most recent one. He raises rates. Number comes out showing that he was right to raise rates. Powell comes out and says, we were right to raise rates. Another number comes out that shows strength, and you start to see what we were discounting. The markets were discounting 2 rate hikes in 2019. They're now discounting 3. Beginning to discount 3, I think, is the way to look at it. But 3, I think, is becoming a safe bet if the trend continues. So the problem with the strong numbers and his behavior is before we get to Trump, because that's really going to be the gold effector, is if the economy is strengthening and the economy is strong, we'll just say it's robust. That's his word. And he's raising short-term rates. Why are long-term rates going up? Now, and this is relevant to gold. As I've said in the past, gold does not care about interest rates. uh, uh, gold cares about the people managing the interest rates. So if the market trusts the people behind the wheel of the Fed uh, being on top of things, then gold will go down if interest rates go up. If the market believes that the Fed is chasing inflation or is being too lax in its vigilance, gold will rally. I think, and we said to we made a recommendation on a weekly report that 1188 was an area we were trading in the 1190s, and we said to buy gold for a core position and consider how much more you'd consider would be worried about losing if we go below 1188. And we're now in that area now. But back to Powell. So he raises short-term rates, right? And what had been happening for about 2 weeks is the yield curve had been flattening, and a yield curve flattening is recessionary. There's no incentive to go out and buy bonds, so people would put their money in stocks, expecting rates to go down, or or people would not put their money in stocks and keep it in cash. But when that happens, they were putting their money in stocks. But the last rate hike we did, the yield curve steepened. So not only did it steepen, you can have a bullish steepening and a bearish steepening. A bullish steepening is when we'll look at the 2 year and 10 year spread. The 2 year and 10 year spread widens, but at a lower level, so they both drop, but the front drops more. A bearish steepening is what we're having now. Is the 2 year drops, the 2 year yield rises, I should say, and the 10 year yield rises more. So you had the Fed raise rates at the short end, and the 2 year yield rose in conjunction with that, but it did not translate into a, hey, you've got inflation under control, we're going to reward you by lowering rates at the 10 year. The 10 year steepened. So that to me is an early sign. It's only one data point that the Fed is possibly falling behind on inflation. I think as they're looking for they're looking for wage growth now, and if they get wage growth, inflation will come with that. They're just hoping to not talk about it too much. I really am having a hard time. I'm not saying they're doing a bad job. I mean, as manipulators, they're doing a great job. But if you look at what's happening right now, they've come out and said, they've been using for months, for years, this dot plot concept, which is a representation of R asterisk, which is what they consider the neutral rate, and what they're trying to find the neutral rate was for the economy. Well, a couple weeks ago, Powell said we're not really sure what the neutral rate is anymore. Well, if you're not really sure what the neutral rate is anymore, and then the next day or the next sentence you say something to the effect of, but we might go higher than a neutral rate. So what they're basically saying, if you take those two statements together as disingenuous, we're not sure what the neutral rate is anymore. We think inflation pressures are bigger than they are showing so far, and we're going to, in our minds, be a little bit more bullish on what the neutral rate is. We're going to continue hiking, and that's when the third hike in 2019 started to show up on the radar. So if PPI comes out today, showing, confirming or showing any signs of inflation, you're going to see a couple things happen. Uh, 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 I don't know which way the markets will go, because let's face it, price relationship to news is not what it used to be. But if the pattern holds, an inflationary number would then, I think, considering Powell's already hawkish, would be bearish for stocks, because he has confirmation that he's right to raise rates. It would be, it could be bearish for bonds, uh, because it shows that he's behind the curve, or it could be bullish for bonds because the market interprets the news as, oh, he's going to raise rates even more, squashing inflation. So it depends on if they trust Powell or not. For gold, if the inflation comes out, um, you could say, gold's going to go up or gold's going to go down. You shouldn't say. You should say, what's the dollar going to do if PPI comes out? And it, it's I don't know, and it's something people don't usually admit. But I think if we have an inflationary number come out, it may. It, I'm leaning towards it being constructive for the dollar, which means bearish for gold. But the driver for dollar strength has not been U.S. Domestic policy. It's been global drainage as a result of QT. And so, when you think of the two things affecting the dollar right now, domestic policy, do we have inflation under control? Is the economy robust? Quantitative tightening puts debt into the market and then tries to sanitize that debt by draining dollars off the market. Well, the global demand for dollars is what's keeping the dollar up, and raising rates uh, should be keeping the dollar up even more. So let's get to yesterday, because I think yesterday is very important when it comes to when it comes to uh, Trump said, "quote I don't like it." President Trump said yesterday, referring to the pace of federal rate hikes, adding, "I like low interest rates." Now, yeah, of course he does. He borrows and he likes to he likes. He's the developer. Developers develop, and he's going to spend as much fiscal money as he can. And he wants low interest rates for that. Um, you know, uh, the president backed up his position by saying the absent resurgent inflation, again, opinion, there's no need to move too fast. For economists like Fed Chair Powell, CPI is the fly in the ointment. While Powell, I'm quoting Bloomberg here, while Powell is confident that there will be no rapid increases as expectations remain anchored, some former colleagues at the central bank have raised questions about the wisdom of being guided by the inflation outlook. We're not going to go down that rabbit hole. But we are going to talk, I think, uh, more about uh, what happened yesterday. So we're going to start with the dollar. All right. Trump speaks yesterday, and the dollar has been showing a lot of strength, getting over 96.10. And then yesterday, Trump makes a statement, and it seems to be, I'm speaking a little bit as a technician now. We have a counter trend move that began uh, yesterday, and it's continuing in Asia today and right now. In the current context, it meant that the dollar is pulling back after a strong rally. Um, I think what is at stake here is what is being indirectly focused on is the Fed's independence, and by that I mean uh, the president reiterated his criticism of Fed policy. I think that may have sparked the move lower. So a technician would look at this and say this is a retracement move or a counter trend move or a swing trade situation. But I think the president's words yesterday sparked the move lower. Uh, that said, the price action in the Fed funds futures market suggests that investors do not think the Fed will change its stance, meaning Powell will be less inclined to raise rates. And therefore, despite appearances, the Fed's independence is still seen as secure. Uh, in effect, Powell's ignoring Trump. Um, December 2019 Fed funds futures contract implies an average effective Fed funds rate to be 2.925 at the end of the year. It's currently at 2.18. So if you take another hike this year plus three next year, that's a full percentage point. So that'll take us to 3.18. So we're going to have between 3 and 4 if Powell stays to his slow and steady situation. So it's basically three hikes. So the Fed's projections are for change lining up with what they want. Um, so let's bring this to gold, and we'll get right to it. Now that we know that, keep in the back of your mind that PPI is coming out today, and we don't know what it will do to the dollar. I am leaning towards it being bullish for the dollar. If PPI shows strong inflation, I'm not married to this. I'm not trading off of this, but I'm going with a slight bias that An inflationary number would be bullish for the dollar because it would give more impetus for the Fed to hike. If an inflationary number came out and the dollar went down, that would mean that the dollar had gotten ahead of itself, buy the rumors, sell the news, or the Fed is beginning to be perceived as behind the curve. That will be reflected more in the 10-year bonds. But as of right now, uh, uh, an inflationary PPI that comes in above expectations would be, um, I think, slightly bullish for the dollar. Okay, so that said, you had the dollar moving higher and gold moving lower, and then the dollar sold off. So basically, from the beginning of the ninth, right, you have the dollar having a steep incline and then a decline. I would call this the Trump effect as it came off, and now it's rallied a little bit and backing off a little bit. So it's still digesting. I think what Trump said. Let's compare that to gold on the hourly. Now, during that same time frame, okay, what did gold do? All right. All right. So when the dollar rallied, gold sold off steeply. All right. It's not a lot, but went from 95 down to a low of a little bit above 86 in this candle here. What was that low? The low was 86.60. Okay. Now the president makes a statement, and if you remember how steeply the dollar sold off, gold uh, rallied in an almost cautionary fashion. It wasn't as steep, it wasn't as V-shaped. It was V-shaped, say, to here, but then it started going sideways. I continue to believe that there is gold above the market to be sold by either an emerging market that needs dollars. There is a crush. There are central bankers in these smaller markets with small offshore floats that are dependent on buying oil. With oil at $75 and the dollar as strong as it is, that's a contradiction for us. We don't see that as inflationary. We're not feeling the effects of inflation because the dollar is stronger. This is the effect of quantitative tightening. In effect, it exports initially deflation. Our deflation goes out, and it becomes everyone else's inflation. So I'm I'm Australia. I have a G10 currency, but I have a small offshore float. And because I have a small float, because I have a small float, I'm dependent on trade to the velocity of money to keep my currency liquid. And with the dollar stronger and my needing to use dollars to buy oil, I'm an importer of oil. I have to sell my own currency um, to get dollars, and I weaken my own currency in doing that. So by weakening my own currency to be able to buy oil at the higher price, I cause domestic inflation. Now we're going to talk about this in the stock market because I think it's a totally rigged game. Before we go, but let's finish up with gold. Okay, the numbers in gold remain for me, and I said a couple days ago that a serious penetration of 88 uh, would be important. I have to uh, do something about this percentage showing here, but I think a decent penetration of 89 is very bearish. Uh, this is a subjective concept. You'll see. For me, a decent penetration would mean I want an hourly bar to settle under 89, or I wanted to trade under 89 on heavy volume and not bounce and go sideways for a little bit. You see, it did trade under 89 on several candles. This is an hourly chart. And in all those candles, you had long wicks below. So that implies there's buying in that area. It's if we get through that area or retest it and don't bounce that I think you should be concerned. And those numbers underneath 89, 88 area, if you want to call it the low now, if you want to move that number that I'm saying at 89 to 87 to 86 and a half, feel free to do that. It's not a bad trade if you want to be long here with a stop out on the new number. As things stands right now, on my system above 94 and below. I have to go to the previous bar. Above 94.20 and below 11.90, um, which is where we are now. If the hour closes below 11.90, I would get a signal to sell. I rarely act on these in the first hour of the day. And that's because the first hour is following a sideways movement overnight if the market was traded thinly the night before. Anyone who's familiar with algorithms knows that what solves this problem is called continuous volume bars, or continuous or constant weighted volume bars, CWVB or CVB, I'm not sure. But anyway, below 1189, I get squirrely. On a purely technical basis, I think if we get below 1189, you can do it Paul Tudor Jones. I'm not going to do that, but a Paul Tudor Jones would be, he'd short it and have a tight stop, and if he's wrong and it goes below, he'd short it and have a tight stop. He'd keep doing it until he was right, or until it went through his stop in a way. So he might short at 1189, stop himself at 1192, and do it again and again and again. And when he stopped himself at 1192, if it went above, say, 1195, he would say, okay, his idea is wrong. So he would be short the market with tight stops. Other people, other fund managers might be short the market with a wider stop. I typically use tight stops, but the indicators that I use are very rare and momentum related. If I'm right in 15 minutes to an hour. Now, if you go to the gold 4 hour, I want to touch on the stock market here before we go. If you go to the gold 4 hour, I think it looks bad. I think if you can ignore all these trend lines, if I can remove these quickly, I would, but I cannot. I think you have this sell off, right? From I think we said to buy it. Where is that? There was a triple. It was on the hourly. It's a triple top. It came in around here. We said to buy it. It went up. It went down. And so now you have to think about, if you bought it when we said to when we advised the client actually to buy it. If you bought it, you have to think about how much pain you're willing to risk below 1188. Do you want to buy more, or do you want to consider what your stop loss is? But I think the market looks bad here as it's chopping sideways. Uh, the rally yesterday, on Trump's words, was anemic, and I think the market. I would like to be long the 1189 straddle. Let's just put it that way. I don't think we're going to be here much longer. It's doing the work here, but you could say it is basing for a move higher since 1189 is held. But I'm not putting much faith into it. I'd be long with tight stops or short with tight stops right now. What I do want to talk about is uh, is relevant to our markets, and that is well, the stock market. All right, for just 1 second. This is something that I don't get a chance to talk too much about. Larry knows a lot more about it than me, but what I want to talk. This is a 4 hour chart. It works like this. Why is our stock market going up? Other than all the news headlines you see, it works like this. Quantitative tightening, we issue debt and we drain dollars out of the market at the same time. Uh, uh, Doing that concurrently is an attempt to stabilize inflation. So there are less dollars. European yields are low to negative in some areas. Emerging markets are struggling. Let's forget about emerging markets for now. If you're in Switzerland and you need to put your money somewhere and your bonds are yielding negative and dollars are strong, what are you going to do? And you've already bought, 10% of Apple's float. I don't know what the number is, but central banks in Europe are buying American stocks. They are the next buyer after, so our hedge funds can get out, so our pensions can get out. They're the next sap, if you will, or maybe they'll make money. Who knows? So it works like this: dollar goes up in value, right? So our fiat goes up in value because we're pulling it off the market. The Swiss print more francs, buy more Apple stocks. So one of the mechanisms that's causing the market to be buoyed despite global problems is a direct comment on foreign money coming into our markets. It's kind of messed up our cycle of rotation as well. And uh, I think I think that's pretty much it. If you want to look at it, we have three big bubbles. How they'll break, when they'll break, and who will break them, I don't know. But they're in the stock market, they're in the bond market, and the third bubble is in the real estate market. Not necessarily the U.S. We're not as leveraged as we used to be, although we do have room to leverage. Remember, we have bullets; we can lower rates. The rest of the world cannot. I think the world will have problems, and if we have problems, yes, 8:25. Okay, we have to go. We have a number coming out. Thank you for joining me. I hope this was informative to you as it was fun for me. I'd like to have a shout out to Cooper, who's joining us for the first time today, and to have a great day in the markets for all of you. Just remember, PPI, how the dollar reacts is how gold reacts. Got to pay attention to currencies. Have a great day and be careful.